All right, and we are back. Welcome to the 5th episode of the Q&A show that I've been doing for real estate investing. If you've watched the other 4, thank you for watching. If this is your first time watching, please go check out the other ones. Some really awesome questions, and I think some pretty detailed and good answers. So I hope you enjoy it. Before we dive into anything, just real quick, if you haven't already subscribed to the channel, I'm going to be trying to put out more, do more clips, do more things in the future. So please do hit that button, get notifications, give the video a thumbs up, all the stupid shit people ask for on YouTube. But would really be appreciated if you did like it. Some updates on what's been going on. First off, happy August 1st, everybody. Don't know when this is going to go up, but today is August 1st, so happy August. If you are working through the month of August, kudos. A lot of people take off, and if you're taking off, enjoy your time off. It's a really good time of the year. Myself, probably not going to take too much time off. May go on a small vacation, spend a weekend with some family. But other than that, just going to stay in work mode. Hopefully find a deal while some other people are sleeping. Housekeeping. Let's see. What do we have going on? Update on Columbus. Our 360 unit we have under contract. We got all our bids back, and we should have our investor book put together by the end of the week and sent out. We've had some really good feedback from investors that are really interested, so really excited to get that out to everybody and get some real feedback from people and see what everybody thinks. I think it's going to be pretty attractive for most people. I think a lot of people are going to like it. It's a heavier lift, but good returns in a market we really know very well. So excited about that. They also just started demo on our new office, which should be pretty exciting. We thought we were moving to another building, but we're actually just moving one floor down, so moving on up. But we're getting a bigger office, getting it built to suit. Right now we're kind of in a shitty space for subleasing, so it'll be really interesting. We're going to take a office and use it as like a media podcasting room where we'll have all the gear set up and ready to use all the time. So hopefully, we'll start doing a lot more, videos, content, guests, interviews, questions. I really want to start doing like some deal review stuff. I think that'll be really interesting. A lot of people have asked for it. So, hopefully, inside the next month, we'll be in there. Very latest October. They said August, but probably not going to happen. But really excited about that. It's going to be really cool. It's going to be really nice to have a space that's really our own. I'll have to look back, see if we had videos. When I first joined, we had like a really, really tiny office. It was just John, Don, and me, and I was sat and like cramped in this little corner with my laptop. Then we moved across the hall, and we brought Lauren on, who helps on the administrative side, and it was still really tiny. I mean, it was 4 L desks that you could barely walk between. And then we moved over here into a totally separate building. It's a little bit bigger, but it's just not ideal. So it'll be cool to finally get over into a built-to-suit office after 3 years. So I'm really looking forward to that. There'll be tons of pictures of. Hopefully I can get in as they're demoing. We tried going down earlier, but the office was locked. Hopefully I can get some pictures of everything removed and everything up, and then do a mini tour. But that's really what's been going on here. Other than that, just really trying to continue to pump out some videos and some stuff for you guys. So if you have any ideas for questions in the future, drop them in the comments below. Shoot me a DM on Instagram. Shoot me an email, chris@torarep.com, and let me know. But with all that being said, let's dive right into the first question. They're all from Instagram tonight. Didn't take any from Bigger Pockets, so thank you to everyone that did reach out and submit a question. Got 3 pretty good ones, I think. First one short. How do y'all, must be Southern, find deals off market? Do you let them market to them consistently? I'm going to assume that means do you market to them consistently? So I'm going to take this and say how we do it, and then I'm also going to say how the ideal way to do it is, because we're not 100%, gung-ho off market. We definitely know how to do it, and we're not the best at doing it. But for off market deals, first, it really depends on what space you're in. But off market, the best ways are direct mail. Go over here. Direct mail, cold call, drive for dollars, knock on doors, broker or agent relationships. That's 5. I'll do that way. Other professional relationships, so mortgage brokers, accountants, property managers, things of that nature. Trying to think what else. Those are really, I may come up with some others, but those are the biggest ones right now. And it's really just leveraging all those different resources. The easiest one to start off with is broker or agent relationships. You just got to form a relationship over time and have a proven track record and a proven way to close. The easiest way to get an off-market deal sent to you first, right? If you want to be that first call, there's two things you can do. Is one, do what you say you're going to do all the time, consistently, follow up, and close on a deal. Especially the trickier deals or the deals that have some weird component to it. You're going to get a deal sent first. The deal we're closing in Columbus is very tricky. The financials are a mess. We weren't able to get into all the units, and the seller is kind of giving us a hard time getting through it all. But because we've now gone hard and we're about to get the money raised, and we'll close because we've done 3,200 units already. It's not going to be a problem. We had a broker call us and say, "Hey, you guys are taking this down. That's super impressive. I promise you are literally the first call for this deal." We ended up passing on it just because it was right around the corner, and we felt it was overexposure to that specific submarket, and we'd prefer to be a little bit diverse within markets. But it's just an example of how that works. So that's broker-agent relationships. The second part of that is niche down into what you want. Have a criteria. Don't just call somebody and say, "Hey, I want to buy multifamily in Ohio or in Columbus." Right? When I call somebody, I tell them, we're looking for, 70, 80, but really 100 units plus, up to 300 is kind of our sweet spot, I'll say, but we can go more. We're looking for B and C class assets, 1960s to 1980s built, and really looking for a story behind those properties. We don't want a deal that was bought 3 years ago. They did some exterior work or blew out the exterior and only did 10% of units. We like long-term owners, operational inefficiencies. I have a criteria that I can continue to repeat. And when they hear the same thing and they see we're closing deals, whether it's in their market or in another market, they start to understand that if this deal crosses their desk, we're the group to call, or we're one of the groups to call. If you say, "Hey, I want to buy multifamily in Columbus, Ohio," and they're just going to shoot you whatever they have. It could be a 90-unit high-rise in downtown Columbus. We are never going to buy that. And if you don't specify what you want to buy, they don't know what to send you. And if they start sending you stuff and you're not buying, they're just going to be like, "All right, these guys, they can fuck off." So that's brokers. In terms of like true off-market, download a list, send a direct mail, and send that person 7 mailers over, every 2 weeks, every month. Don't just send one and stop. The calls you get on the first direct mail, I would say almost 100% of them are going to be non-starters. The reason being, they probably get a ton of mailers and they're trying to find the sucker that'll overpay for it. Maybe you just happen to catch the person at the right time. They've gotten 10 mailers and they've been thinking about selling, and they had an agent sell, and then they get your postcard and they're like, "All right, let's give this guy a call, see what he'll offer." More often than not, they've gotten a bunch. They know what their property's worth, and they're just trying to find somebody that will pay more than what it's worth. But if you send it multiple times and they see you following up and you do it slightly different, and maybe you handwrite one, and maybe you send one that's yellow or red, or one's really big or one's really small, like, I don't know, just mix it up. It's time, and it's just catching that person at the right time. It's the same exact thing with cold calling. They're two very similar things. If you cold call someone out of the blue, the first conversation, if they're like, "Yeah, I'd love to sell you my property," I'm super, super skeptical. Unless they're like a more sophisticated owner, and it's just, they have been thinking about selling for a little while, and instead of going through a broker, you just call them on the right day. It's going to take you a couple points of contact before, you really get a good deal. We've been doing a ton of direct mail and cold calls for mobile home parks for about 7 months, and we've bought 2 tiny parks, and those, I don't even know if they really count. It was kind of before we really started. We've got a ton of contracts and offers out right now, so it's started to pick up in the last 15 to 45 days, but it took months and time of and we've got a couple people in the office that are really running this, and they're in here, 3 to 5 days a week, 8 hours a day, doing this stuff day after day after day, and really put in the time and effort and the follow-up. So, yes, you have to consistently follow up with these people to try and get an off-market deal. In terms of other relationships, as you're dealing with other professional relationships, property managers, mortgage brokers, insurance guys, just ask, say, hey, next time you talk to some of your other clients, your other groups, just ask if they have a deal that they're thinking about selling. And if you think it would be a good fit for us, if you wouldn't mind putting us in touch or playing an intermediary, and then compensate that person for doing it, because if you do, they're going to appreciate that, as well as they'll bring it to you. And if it ever comes up again, they know they can come to you to get paid. But as far as off-market deals, those are the ones we do. A really cool tactic that I like, especially for the bigger stuff, or I guess you could do it for the smaller stuff too, is if there's a deal that gets listed and you like that area, call the 10, 20, 30, 50 properties right around it and try and get in touch with that owner. And then try and get it for a little bit cheaper if you can, or a lot cheaper if you can, because then you've got a really good barometer of where the market is right there, and what the current market is. And, you can kind of play off of that to find other properties. So as you're digging in for that one that's listed, maybe you like it, maybe you don't, a little bit irrelevant, but you're going to start knowing about that immediate area. If you know it really well and you've already been cold calling, maybe use it as a point of, hey, this deal is selling, you can save this amount of money. So, I can afford, I can pay you X. You can get a deal for a little bit cheaper. You can say, well, I think, it's really, they're asking $325, it's really worth $300, but if you don't have the closing costs with an agent, if I give you $275, you'll net the same. Now you get a property for $50,000 cheaper. They get the same as what you think it's worth or what it'll trade for. And everybody is happy. Or maybe you give them $285 and you split the difference, whatever. There's all different strategies, but really cool or really interesting strategy, I think. Deal gets listed, call the 20 properties, 5 properties, 50 properties around it. Depends upon what asset and market you're in. But yeah, those are kind of the ways that we find off-market properties, or you can find off-market properties, and some of the ways that you should go about doing it. On to the next question. This is also from Instagram. How do you go about underwriting every specific little thing? It's a little bit vague, so I just clarified. Can you just expand? And he said, the fact that I've read to never trust a broker's OM, that's operating memorandum, that's like a listing from a commercial broker. So just doing your own math on potential rents, expenses, fluctuating, taxes increasing, NOI dropping tens of thousands from the previous year, etc. Basically, do you guys do best case scenario and then worst case scenario to see if you could still survive it? What are little key points you look at that make you feel comfortable with moving forward with a deal? So I love this question because I, one, haven't really spoken too much about underwriting, and two, I think it gets into a really interesting point on underwriting. If you are in the multifamily or commercial space and you get sent a book from a broker, they're almost always going to give you their underwriting to show you, hey, this property is worth X today and it's worth Y in the future, and you can make Z, so you should buy at the price I'm asking for. Maybe it's worth it, maybe it's not. But when you're looking at their underwriting, they are trying to sell you a property. So take everything they tell you with a grain of salt. Some of the stuff is going to be correct, like a lot of the property information, the renovation plan, the average rent, the stuff in the book for that is 99 times out of 100 correct or very, very close, that you can take it with, without the grain of salt. But things like you can push the rent to Y and you can spend X to get it there, or you can operate your property at $5,000 a door, or $300,000, depending upon what it is. That stuff, I would always, always, always do your own underwriting. I was speaking with our small balance lender for Freddie Mac at CBRE, and he was telling me that there's a lot of people that buy their own deals and they literally just submit the broker's underwriting. And I'm just shaking my head thinking, the amount of books I've seen that are just wrong, or just not even wrong, just how we wouldn't operate the property, is mind-boggling. And sometimes it's the other way too, right? Sometimes it's too expensive and sometimes it's, way cheaper. And I'll get sent a book if it's higher than what we can do, I'm super happy because I'm like, okay, if everybody thinks that, or a bunch of people, but I can do this, that's a great thing. If it's way low, I'm gonna be like, what are you thinking? So always, always, always do your own stuff. The way we get our information is track record, experience, property management, other properties, things of that nature. So, we'll never buy the first deal in a market that we see unless we have other resources. And what we'll do is those broker books, all right, we'll start looking at what other people's expenses are. Our property manager will always, manage deals in that area. We'll leverage the other properties that they manage. They'll do their underwriting, we'll do our underwriting, and we'll communicate in between ours. And we'll look at, what do we think we can operate this at? What are our expenses going to be? What is our income going to be? For the rent side, we will look at all the properties close by. We'll start directly in there, and then we'll spread out, and we'll look at renovation scope, square footage, and what the rents they're achieving are, and then we'll plug those scenarios in and kind of see, okay, well, if we do this renovation, we can take it from 600 to 700, but if we do this one, we can go from 600 to 750, but it's going to be more expensive. So what's your ROI to get you to 750? Does it make sense? Or do we do less and go, only to 675? And, we'll look at things like that, and we'll see, how many units are already renovated? How many do we want to leave left for the next buyer? Do we want to do multi-level, renovations? Do we want to do two different types so that there's a variety for the tenant as they come in, as well as the next buyer can choose to do either one, and you can prove out both. Do we want to renovate the whole property and sell it as a stable? So there's a lot of different factors we'll go into, and depending upon what type of renovation we do, because we buy all value add. So this is talking for value add, not necessarily stable property. Will depend on the cap rate you sell out at the end. That's the other thing too. A broker is always going to take today's cap rate, and they may even go lower. We will always take the cap rate and make it higher to be safe. And how high we go just depends on, how much meat is left on the bones, how much value is left, what's the area like, what do we think the market is going to be like in 2, 3, 5, 7 years, et cetera. And it's always a sliding scale. But just want to make sure I'm catching every little thing. But the way we kind of get all that information is, past experience, other deals, other information from other books and brokers. We have, if we look at 10 other deals, they'll send you the financials for those 10 deals. So I'll take those financials, I'll look at how they were operating and say, all the, the payroll is $1,100 a unit. If the current owner is at $1,500, all right, there's an expense I can probably cut. Maybe I can't get $1,100. Maybe there's a reason for that, but maybe I can get $1,200. Or maybe they're super low. Maybe they're at $700 because they're a mom and pop, or they've had somebody working there for 15 years. And if you go to the free market, you're not going to find that rate for a manager anymore. So I know, okay, well, that rate's going to go up. The tax side of things, we'll do two things. We'll, one, figure out how it works in the area, and two, we also have third-party tax consultants that we will use, especially for a new market, to make sure. So, for example, right now we're really, really, really strongly pursuing buying multifamily in the Indianapolis market. We're in a bit of a discrepancy right now because our tax guys telling us one thing and the brokers are telling us another thing, and they're very reputable brokers. They're only Indianapolis based, so they know the market like the back of their hand, and we're trying to figure out, what the real story is and, how to figure it out. So, we've looked at a couple deals. We were going to offer on the last one, but then, our tax guys told us it was going to go up, 80% reassessed of the purchase. The brokers were telling us it was like 45, 50. It was a big difference. So we weren't really sure. So we said, let's see, what happens with this one. Let's use it as a case study. We really liked the property. We were actually at market value, but it was an opportunity cost that we weren't willing to take a gamble on. And we said, let's use this as a case study for the next 6 months going forward. So we'll look at things like that and see what happens and see what does actually happen with the reassessment. Is it 50 or is it 80? And if it goes to 80, well then, wow, it's a good thing we didn't buy that. If it goes to 50, all right, we missed the deal, but we didn't lose money. We lost an opportunity. That's not the end of the world. In terms of scenarios, because that's kind of the second part, he was asking, do you guys do best case, worst case? We will stress test every single deal we look at. We'll look at, what cap rate will get me a net zero return, and make sure that it's super high, like an 8 cap. And that's even with positive cash flow every year. That means technically you're selling it for less money than you bought it for, but the cash flow and the sale net out. What is that like? If it's a 6.5 cap, we're never buying that deal for that price. That's way overpriced, and it's just not happening in the markets we're in. If it's an 8 cap, all right, we feel pretty safe. If, in the next 5 years, if that's our business plan, if, cap rates go to 8, everyone's kind of getting shafted a little bit, so we'll be in good company, but at least we know, hey, we didn't lose anybody any money. We didn't make anything, we didn't lose anything, or we'll be pretty close to net even. The other thing, we'll look at is our break-even occupancy. Where can our income come down to so that we can still afford to pay our expenses and our mortgage every month, and we don't have to call investors to raise additional money or to tap into our reserves or a capital fund if we're doing upgrades or renovations. We don't want to do that. So we want to look, and we really look for, in and around 70%, because that would be a pretty significant drop. So we definitely look at it from that scenario. And what we'll also do is we'll look at, a lot of times, like I said, we'll sell at a lower cap rate than it is today. If it's a 5 cap, we may put a 5.5. If it's a 5.5, we may put a 6. Whatever it may be, we'll look at a sale and say, okay, let's say it stays the same. How does this look? And we'll say, okay, that seems pretty good. And then we'll drop it to a 6, and we'll present it as a 6 to other people. But we'll know that if all things being equal, we think we can do a lot better than we have on paper, and that's why most of the deals that we've done, are well and above 20% returns to investors, even though we're telling people 12, 15, 18, just because cap rates have, not only compressed. Well, they've compressed or stayed level in the last couple of years. So that's why we've continued to outperform for the most part. There's deals that we have not outperformed on for various reasons, but for the most part, on average, our deals are over that. So and then that stress test of what is it? What does a 7 cap get us? Is it 10%, 12%? We'll look at that just to understand what it is. So we'll definitely stress test. We'll do what we can to make sure, hey, if it, what's the chance it drops to 70, and are we okay with that? We don't think we'll probably drop to 70, because that's pretty safe. So we're usually pretty comfortable there. If we start getting mid-70s to upwards to 80, unless it's a really quick turnaround, we're doing a lot of renovations and it's a big lift, we're probably going to avoid it. It probably just doesn't sit right, or we'll drop the debt. So instead, usually the break-even gets higher as you get, a higher levered loan. So if that break-even occupancy is too high, we'll just get less debt to make it less risk-averse. And if the returns aren't there, we'll either lower our offer or we'll move on. So there's a lot of things we'll look at. We're definitely doing a lot of our own stuff. We're definitely double checking. We're definitely stress testing. And I would encourage all of you, whether it's a single family house or a 300 unit, multifamily property, to really do the same stuff and feel very comfortable in what you're doing, and know that, if this happens, I'm still safe and I'm not losing money. And the last question: what are your thoughts on co-living in cities where rents are high? I see it trending. And I bring this up because there's a fine line for being co-living, and just he specified for furnished all-inclusive co-living solution. So when I say I asked specifically co-living, it's funny because I think a lot of people are classifying co-living as just finding a roommate. And that's, for me, is not co-living, right? If you think co-working, it's somebody took a floor of an office, broke it up into way smaller things, and they're renting it out on a month by month basis. That makes a lot more sense. Or it's an open space and they're giving you a desk, right? Like you've got to share facilities with somebody that's sitting right next to you, and you've got to work out resources and conference rooms and shared community areas and noise and bringing stuff in. So it's more sharing a lot of the same stuff. You find a roommate, that's been around forever. That's not co-living to me. I mean, it is, but not really. For me, co-living is where you now see, multiple people in the same room, or, really, really micro rooms in an apartment. Maybe you could classify that, but that's been in New York City forever. So I'm definitely seeing a little bit. I think some stuff is maybe a little bit misclassified for me, unless they're, if they're renting out the bed, maybe, I don't know. But my thoughts on co-living are, I'm kind of passive to it, agnostic, I guess. Is that the right word, or is that just a religious word? I don't know. But my only concern with it is the sustainability of it, because history tends to repeat itself, and it's funny because a lot of people of my age, in their 20s now, young professionals have moved into the urban areas, but all my parents' generation, they grew up in the areas I'm living in now, in Brooklyn, in Queens, in the city, and they moved away as soon as they could. They moved to the suburbs, and the city wasn't nearly as popular as it is now, or these urban areas, from my understanding. That's what I've been told and what I've heard and things I've seen. So my thought process is, if that's already happened, it's probably happened several times over. It's going to probably happen again as things get way too expensive. People are probably going to want to move out, or people just like change. And if all your friends and family are moving out to the suburbs, you're probably going to end up following along because you don't want to drive 2 hours to go to your niece's birthday party and then your uncle's wedding or whatever the fuck is going on every weekend. So it's just shift mentality. What happens if people start leaving these areas? How does that build to suit property sustain itself? Is there always going to be a demand for co-living? Do they have a plan to take that co-living and turn it back into traditional if they need to? Does that affect the value? I don't know. I don't know enough about this stuff. I've never really dealt with the process of it. But those are just the things I think about when I hear about co-living. And it's the same thing for co-working. What happens if, are they buying on increased valuations to turn it into co-working so it's more valuable than if it wasn't? And then what happens if co-working goes out of phase? It's the same concept. I feel co-working is probably more sustainable just because it's now proven for a couple of years, and I personally can see the attractiveness of it. But I don't know if I personally would want to, like I saw co-living with bunk beds in San Francisco for like $1,200 a month. I did a story on my Instagram about it. I don't know, maybe a month ago now or 2 weeks. I don't even remember. I wouldn't want to do that. Now, I guess if that's all you can afford and you want to live in San Francisco, great. But I think there's probably got to be cheaper alternatives. It's just not going to be as nice as you want. It's not going to be a brand new building. So, if you don't care about it, if you work 14 hours a day and all you're doing is sleeping there, I don't know why you need the nicest place in the world. I would go live in something for the same price with more space and privacy, but, more run down. I don't know. I think the sustainability aspect of it is very unknown right now, and I'm curious what their fallback plans are and their contingencies are for something like that that's in place. It could be that they have, systems in place that are very reliable, and, the metrics work out that, they're underwriting to. If it turns into traditional multifamily, it makes X percent, but if we can keep it as co-living, it makes a lot more because, our price per square footage goes up, right? If that one bedroom that has a bunk bed in it is $2,400 combined, but it's only $2,000 with, traditional multifamily, well, you lost $400, but maybe at a 2,000 average rent, it's a 6% return, and the 2,400, it's a 12% return, or I don't know, whatever. Hopefully you understand what I'm trying to say, but if they have that, I think it's more appetizing from an investment standpoint. I think if it's just going straight co-living, I am more wary about the future of it and the actual demand. I know there's been some company just came out and they're doing like co-living for undergrad, graduate students, and recently graduated college students, and they're doing it in big cities. There was a whole big article about it, like hundreds of millions of dollars being pumped in, and they're going to build these properties, so I think that model is interesting because I think there's always the need for cheap living for students, and the co-living aspect for students is very similar to dorms. Honestly, I don't understand, the co-living for the student housing. I feel like most student housing is co-living. Oftentimes there's 2 beds placed in a room. Oftentimes shared bathroom, shared kitchen, shared amenities. Again, it's a gray line. It just sounds like they're accepting, post-grad students. Again, it's all kind of blurred for me, so it's a little tough. But if you're, just extending the student housing to post-grad students, and maybe it's a little bit more co than some other stuff, I think that's an easy transition just back to, traditional student housing. So that makes sense to me. But I think if you're free market co-living, high expense areas, and you're just trying to get, a cheaper alternative, but, your price per square footage is significantly higher, I don't know the sustainability of that because of the potential for people to move back to the suburbs and just kind of see how history repeats itself. But that's it. That's all the questions for tonight. I ended up going a little bit longer than I thought I would, just kind of rambled on a little bit, but I think touched on some good stuff. So if you got all the way through, thanks for listening. Like I said, if you don't mind hitting the subscribe and like button, I appreciate it. If you have any feedback, good, bad, indifferent, still trying to figure all the YouTube and stuff out, and just trying to put out information that I see, feel, can regurgitate from better sources than me. So any feedback is appreciated. If you have any questions you think would be good for this and you want to see it on a future episode, drop it in the comments. Shoot me a DM on Instagram at GrenzigCRE. Shoot me an email, chris@tororep.com. And that's it. Thanks for watching.